My name is Ronnie Michael, certified public accountant, and this is the Personal Finance Playbook. Improve your finances, improve your life. The title of today's short talk is You Are Not Nancy Pelosi, The Perils of Timing the Market. It's never been easier to buy and sell stocks. In the pre-internet days, you would actually have to get on the phone and ask a stockbroker to initiate a transaction on your behalf. Then the internet came along, and now you can make transactions by yourself with just a few clicks. Then the smartphone era came along, and now you could transact stocks anytime, anywhere by pulling your phone out of your pocket and just making a few swipes. Some apps, like Robinhood, even allow people to buy and sell stocks without paying any fees. In the span of just a few decades, buying and selling stocks went from an activity that required planning and knowing the right people to something that has virtually no barriers to entry. Overall, I think it's a benefit that more people than ever now have access to the stock market. But historical barriers to entry weren't all negative. Stock trading comes with potentially severe risks, and unfortunately, too many people are unaware. I once had a conversation with a young woman, probably around 30 years old, who told me that she wanted to learn more about investing this year and then was excited to start trading stocks. Apparently, she was under the impression that after learning a bit about investing, she would know how to time the market and she could easily start making money by stock trading. My response to her was basically, You are not Nancy Pelosi. Unless you have some inside knowledge about a particular company or industry, which itself puts you in a legally dubious position for stock trading, it's extremely difficult to make any kind of meaningful money over a significant period of time. Expecting consistent profits from stock trading is like expecting consistent profits from placing bets on your favorite sports team. Some people think they know how to make money through stock trading as they can recite the old adage, buy low, sell high. But how do you know when the stock is low? And how do you know when the stock is high? Even professionals who trade stocks for a living don't really know. A vast majority of actively managed mutual funds, i.e., funds that are run by professional stock pickers, routinely outright underperform basic stock indices like the S&P 500. And that's without getting into other issues like fees and taxes. If a professional struggles to time the market, what makes you think you can? Even when a professional stock picker does demonstrate a sustained ability to time the market, people can still underperform. Let's take the case of the Magellan Fund. The Magellan Fund is an actively managed mutual fund, perhaps one of the most popular and best known in the US. From 1977 to 1990, it was managed by Peter Lynch. During these years, Lynch managed to achieve an average annual return of around 29%. If 29% sounds large, that's because it is. For some perspective, the average annual return for the entire US stock market between 1872 and 2024 was about 7%. So, all the investors that happen to invest in this Magellan fund made bank and lived happily ever after, right? Well, not exactly. As you might imagine, the fund didn't earn a 29% return every single year. There were some years well above 29% and some years with negative returns. Human nature being what it is, what do you think happened after a great year? A bunch of new investors got into the fund. And what do you think happened after a poor year? A bunch of investors got out of the fund. All told, the average investor in the fund over this time period actually lost money. It wasn't buy low, sell high. It was buy high, sell low. Here's one last data point to drive home the idea that timing the market is extremely difficult. Morningstar, one of the most popular investment research companies out there, has conducted research on this issue. Between 1997 and 2017, a period of 20 years, there were 5,217 trading days. If you owned the US stock market for all those trading days, you earned a compounded annual return of 7.2%. If you happen to miss the best 10 trading days during that time period, your return dropped to just 3.5%. And if you happen to miss the best 50 trading days during that 20-year period, your return actually went negative. You would have lost 4.5%. Let's conclude with something a bit more positive. It is absolutely possible to make money in the stock market. In fact, the stock market is one of the great wealth building activities available to the everyday person. There are certain strategies like passive index fund investing and buying and holding that have historically had pretty good success rates. But we'll have to discuss those in detail another time. In the meantime, be wary of your ability to time the market. And, like with any investment, never risk more than you're willing to lose. What do you think? Does this apply to your life? Leave a comment below, and thanks for watching.